Most people don't think about debt when they check their bank balance. They think about whether the paycheck arrived, whether the mortgage payment cleared, whether the credit card bill is lower than expected, whether there is enough left over after groceries, utilities, insurance, subscriptions, and everything else that quietly arrives each month. The routine feels normal because it is normal. For many people, financial life is organized around a series of future payments. A car purchased years ago still shapes today's decisions. A mortgage signed decades earlier influences where someone works, how much risk they can tolerate, and whether changing careers feels realistic. Student loans can remain present long after graduation. Even small recurring expenses become part of an invisible structure that determines how much flexibility exists in everyday life. Most people experience the pressure. Far fewer think about why so much of modern life is built this way. The common assumption is simple. Debt is often viewed as a tool people choose to use. A mortgage helps buy a home sooner. A business loan helps launch a company. A credit card smooths temporary cash flow problems. Debt appears to exist because individuals want access to something before they can fully pay for it. That explanation is not wrong. It is simply incomplete, because the deeper reality is that debt does not only help individuals move forward, it also helps entire economies keep moving. And once that becomes visible, many ordinary financial experiences begin to look different. Consider something familiar. A young professional receives a promotion. Their income rises. Confidence improves. New possibilities appear. Soon afterward, they move into a larger apartment. Maybe they finance a newer car. Their spending adjusts to match their earnings. Nothing about the process feels reckless. In fact, it often feels responsible. The increase in income supports a larger financial life. But something else happens at the same time. The higher income becomes necessary. Expenses that once felt optional become fixed. What began as greater freedom gradually becomes greater obligation. This pattern appears everywhere, not because people are irresponsible, because modern financial systems are designed around expansion. Businesses invest based on expected future demand. Consumers spend based on expected future income. Governments make long-term commitments based on expected future growth. The future becomes part of today's decision-making. Debt is one of the primary mechanisms that allows that future to arrive early. The visible outcome is familiar. Homes are purchased before decades of savings accumulate. Companies expand before profits fully arrive. Infrastructure is built before tax revenue exists. Consumption occurs before earnings are collected. Most people see the outcome. The hidden driver receives less attention. Debt allows spending to occur now rather than later. That may sound obvious, but the implications are larger than they first appear. Because one person's spending becomes another person's income. The mortgage helps support construction workers, suppliers, lenders, inspectors, and countless businesses connected to housing. A business loan supports employees and vendors. Consumer credit supports retailers, manufacturers, and service providers. Money begins moving through the system before it technically exists in earned form. Economic activity expands, growth appears, opportunities increase. The arrangement often works remarkably well, which is why it becomes normal. And normality creates its own form of reinforcement. A family sees housing prices rising and feels pressure to buy sooner. A business sees competitors expanding and feels pressure to invest. Workers see costs increasing and pursue higher incomes. Governments respond to demands for services and infrastructure. Each participant is responding rationally to circumstances. Yet collectively, those responses strengthen the dependence on continued borrowing. Not because anyone intends to create dependence, because the system gradually adapts around expectations of future growth. A small realization often appears here. Convenience has a way of becoming commitment. A subscription begins as a minor expense. Years later, it feels permanent. A larger home initially feels like an upgrade. Eventually, it becomes a monthly obligation that shapes career decisions. A higher income creates opportunities, but it can also create a lifestyle that requires maintaining exactly that income. The same pattern exists on a larger scale. Growth creates expectations. Expectations create commitments. Commitments create dependence. And dependence changes behavior. At this point, debt stops looking like a financial product and starts looking more like infrastructure. Many people only notice this indirectly. They notice that slowing down feels difficult. They notice that reducing expenses requires major life changes rather than minor adjustments. They notice that leaving a stressful job becomes harder once a certain level of responsibility exists. The system becomes visible through personal experience. Because debt is rarely isolated, it connects housing markets, employment decisions, business investment, consumer spending, and government planning into a single network of expectations. Removing one piece affects many others. This helps explain why economies often struggle when borrowing slows significantly. The issue is not simply the debt itself. It is the degree to which activity has adapted around it. Imagine a city during the evening commute. Office towers empty, trains fill, cars move through crowded highways, restaurants prepare for dinner service, delivery drivers move through neighborhoods. The entire environment appears active and self-sustaining, yet beneath much of that activity exists an assumption about tomorrow. Businesses expect customers, employees expect paychecks, lenders expect payments, governments expect revenue, households expect income. Debt functions partly as a bridge connecting those expectations to the present, which creates a subtle tension. The same mechanism that expands opportunity can also increase dependence on continued expansion. The same system that creates flexibility at one stage can reduce flexibility later. Many people encounter this personally without connecting it to the larger picture. A promotion brings relief. Then new obligations appear. Income rises. Expenses adapt. Financial progress occurs. Yet the feeling of needing to keep moving remains. Not because progress was fake, because adaptation happened alongside it. Debt operates similarly within larger systems. Growth creates new possibilities. Those possibilities create new expectations. Those expectations eventually become part of the environment itself. The long-term consequence is not necessarily crisis. More often, it is maintenance. An economy built around borrowing develops commitments that require ongoing support. Households maintain payments. Businesses maintain expansion plans. Governments maintain services. Financial institutions maintain lending activity. Over time, the challenge becomes less about creating growth and more about sustaining the structures already built around previous growth. This is where many discussions about debt become too simple. They focus only on whether debt is good or bad. But most people experience something more complicated. They experience a world organized around future expectations. A world where opportunity, consumption, investment, employment, and financial security often depend on commitments extending years into the future. Debt is one of the mechanisms that allows that world to function. Yet the longer the system operates this way, the more daily life begins adapting around assumptions that are difficult to reverse. Which means the deeper story is not really about borrowing. It is about dependence. Not individual dependence alone, collective dependence. The kind that becomes visible only after enough routines, expectations, and obligations have been built on top of it. And once that becomes visible, ordinary financial experiences begin to look less like isolated personal decisions and more like pieces of a much larger structure. If so much economic activity depends on bringing tomorrow's resources into today, then how much of modern financial life is really built on expectations about the future? Finance Simplified explores how incentives, dependence, and pressure shape financial behavior over time.